Look, I've been managing money for 35 years. I ran hedge fund sales at Goldman Sachs. I managed macro portfolios at GLG Partners. I called the 2008 financial crisis. I called the 2012 European sovereign debt crisis. I was one of the first institutional voices to cover Bitcoin publicly in 2013. And right now, I'm telling you something I've never said before with this level of conviction. Sell everything, except 3 assets, because what's coming in the next 12 months is the largest liquidity event in human history. $10 trillion in debt needs to be refinanced in 2026. That's not a typo, $10 trillion. And when that happens, central banks will have no choice but to print money at a scale that makes 2020 look like a rounding error. Most assets will not keep pace. Most assets will lose purchasing power even as their nominal prices appear stable. Most assets are traps designed to transfer wealth from those who don't understand the game to those who do. But 3 assets will capture this liquidity wave like nothing else in history. 3 assets are mathematically positioned to absorb the trillions of dollars that will flood the system. And I'm going to tell you exactly what they are today. Subscribe now, because this is the framework that will separate those who build generational wealth from those who watch their purchasing power evaporate. Part 1. The math that changes everything. Let me start with the number that nobody wants to talk about. Global governments and central banks are increasing liquidity at approximately 8% per year to manage sovereign debt. This is the debasement rate, the rate at which your money is being diluted. On top of that, you have measured inflation CPI running at roughly 3%. Add those together. What do you get? An 11% hurdle rate. This is the most important number in investing that nobody talks about. It means any investment that returns less than 11% per year is actually losing you money in real terms. You're getting poorer even though your account balance looks the same or slightly higher. Think about that. Your savings account paying 4%. You're losing 7% per year in real purchasing power. Government bonds paying 4.5%. You're losing 6.5% per year. The average stock market return of 10%. You're barely treading water. This is what I call the everything code, the master framework that explains why asset prices appear to rise when they're really just reflecting the collapse of the unit of measurement. The S&P 500 isn't going up. The dollar is going down. Once you see that, you can't unsee it. Part 2. The $10 trillion wall. Now here's what makes 2026 different from any year in history. In 2021 and 2022, governments around the world extended their debt maturities beyond 5 years. They pushed out the timeline. They kicked the can down the road. That can is now sitting directly in front of us, a third of the entire US national debt. Approximately $10 trillion matures in 2026. 1/4 of all federal debt matured in fiscal 2025, and another massive wave is coming. But it's not just government debt. Corporate debt maturities are expected to jump from $2 trillion to nearly $3 trillion in 2026. Commercial real estate faces a $1.8 trillion refinancing wall, the largest in history. Add it all together, you're looking at approximately $15 trillion in debt that needs to be refinanced between 2026 and 2028. Here's the problem. Interest rates are no longer at zero. Treasury Secretary Debasement admitted in 2025 that long-term debt issuance made no economic sense at current rates. The Treasury Department knows they missed the window to lock in cheap long-term funding. They're trapped. The only solution: print money, flood the system with liquidity, debase the currency. This is not a prediction. This is arithmetic. Interest payments on the national debt hit $1.21 trillion in fiscal year 2025, 17% of total federal spending, more than the entire defense budget. Every 0.25% rate increase adds $95 billion annually. The math doesn't work unless they print, so they will print, and I originally thought this crypto cycle was 4 years. I've now extended it to 5 years specifically because of this debt refinancing schedule. The liquidity surge that should have come in year 4 has been delayed to year 5. That's 2026. That's now. Part 3. Why diversification is dead. Here's the implication for portfolio construction that most people aren't ready to hear. Diversification is dead. The traditional 60/40 portfolio, 60% stocks, 40% bonds, was built for a world where inflation was the enemy and bonds provided a hedge. That world is gone. Since 2020, the correlation between stocks and bonds has shifted toward positive territory during market stress. They both decline together precisely when you need diversification most. $1 invested in a hypothetical 60/40 portfolio in 1871 would have grown to $4,203 by 2025, compared to $33,033 in a pure stock portfolio. The diversification protection cost you 87% of your potential returns. And that was in a world where bonds actually provided positive real yields. Today, bonds yield less than the 11% hurdle rate. They're not a hedge. They're a wealth destruction mechanism disguised as safety. The best thing now is hyper-concentration in the assets that can actually beat the debasement rate. This isn't a taste for volatility, it's arithmetic survival. You need assets that don't just preserve wealth, they compound it. You need assets with network effects that grow exponentially as adoption increases. Gold preserves wealth, but it doesn't compound it. Bonds generate income, but that income is below the hurdle rate. Real estate provides yield, but it's illiquid and doesn't scale with network adoption. Only one asset class has the mathematical properties to capture the coming liquidity wave while compounding through network effects. Crypto networks, Part 4, Asset Number 1, Bitcoin. The first asset you need to own is Bitcoin. Let me explain why in terms most people don't think about. Bitcoin isn't just digital gold. It's a network that grows in value as adoption increases. This is Metcalfe's law: the value of a network is proportional to the square of the number of users. Gold doesn't have network effects. If twice as many people buy gold, the price might double, but the fundamental utility doesn't increase. If twice as many people use Bitcoin, the network becomes more secure, more liquid, more integrated into global finance, and the price compounds exponentially. Bitcoin has appreciated at roughly 50% annualized since 2011. No other asset class comes close. But here's what matters now. Bitcoin has become institutional infrastructure. BlackRock, Fidelity, and other major asset managers now offer Bitcoin ETFs. Banks are being granted access to Fed payment networks for crypto custody. The regulatory pathway is clearing. This isn't speculation anymore. This is the infrastructure layer of the next financial system. When $10 trillion of debt gets refinanced and central banks flood the system with liquidity, that liquidity needs somewhere to go. Bitcoin is now institutionally accessible for the first time in its history. My thesis is that Bitcoin will become a better store of value than gold. Gold's market cap is about 15–18 trillion. Bitcoin is roughly $1.3 trillion at current prices. If Bitcoin just reaches parity with gold, not even superiority, that's a 10–15x from here. And that's the conservative case. In a world of perpetual debasement, the hardest money wins. Bitcoin has a fixed supply of 21 million. No central bank can print more. Current allocation: I hold significant Bitcoin as the foundation of my portfolio. It's the least volatile asset in the crypto space. Yes, it still pulls back 30% in corrections, but relative to the risk curve, it's the safest exponential bet. Part 5. Asset number 2, Solana. The second asset is Solana. Now, let me explain. Why Solana specifically? Solana is currently trading around 82–84. It's down over 30% from its highs. The mainstream narrative is that the altcoin party is over. They're wrong. Solana's network fundamentals are stronger than they've ever been. Firedancer, the new validator client developed by Jump Crypto, has processed over 1 million transactions per second in test environments. When it fully deploys on mainnet in 2026, it will eliminate network outages and reduce latency to sub-150 milliseconds. That's not incremental improvement, that's an order of magnitude leap. Here's what that enables. High-frequency trading firms can build on Solana. Global payment giants like Western Union are testing stablecoin settlements. Real-world assets worth over $1.66 billion are now tokenized on Solana. Morgan Stanley and WisdomTree have expanded their institutional presence. Solana is transitioning from a memecoin hub to an internet capital market. The institutional sticky capital provides a floor that speculative retail volume cannot. On my risk curve framework, Solana pulls back about 50% in corrections, while Bitcoin pulls back 30% and Ethereum 40%. It's higher on the risk curve, but it's earlier on the adoption curve. My general thesis for the full cycle is ETH outperforms BTC, Sol outperforms ETH. Why? Because they're at different points on the network adoption S-curve. Newer networks have more room for expansion relative to their size. Solana's ecosystem is exploding, wallets exploding, stablecoins exploding, developer activity exploding. The price hasn't caught up yet. That's the opportunity. Part 6. Asset number 3, Sui. The third asset, and this is my largest position, is Sui. Yes, I know, it's controversial. It's trading around $0.94 right now. It's down significantly. People are skeptical, but let me show you the data. Using Metcalfe's law models, looking at active users and stablecoin flows, Sui is approximately 80% undervalued compared to Solana. The technology is unquestionably excellent. The Move programming language offers advantages that Solidity Ethereum's language doesn't have. Transaction finality is near instant. The user experience is smoother than any other L1 I've used. The question, and it's a fair question, is whether Sui can prove practical application value. Can it get adoption? Here's what the data shows. User growth on Sui is faster than Solana was at the same stage of its life cycle. The value per active user is higher than most competitors. Wallets are growing, stablecoins on Sui are growing, BTC bridge to Sui is growing, developer activity is growing. The pattern looks like Solana in 2021, before it went from $4 to $250. Now I need to be transparent. I have over 70-80 of my liquid crypto allocation in Sui. That's an extremely concentrated bet. I'm connected to the Sui Foundation through Real Vision partnerships, but the data-driven reasons for conviction are clear. My thesis for the full cycle is, Sui outperforms Sol due to where they are on the network adoption curve. Sui is the highest risk, highest reward position of the three. It pulls back 60-65 in corrections. It's not for everyone, but if Sui achieves even partial success, if it proves the adoption thesis, the returns could be extraordinary. In the exponential age, where network effects compound exponentially, being early on the adoption curve is everything. Part 7, the DFU framework. Don't F this up. Now let me give you the framework that ties this all together. I call it DFU don't F this up. The core principle is not to make the most money. It's to avoid losing too much, then compound over the long term. That sounds boring, but that's the truth. Here's how it works. 1. Understand the risk curve. Even among these three assets, there's a risk curve. Bitcoin pulls back 30%. In corrections, Solana pulls back 50%. Sui pulls back 60-65. The risk is proportional to where they are on the maturity curve. Bitcoin is the most mature. Sui is the least mature. Position size accordingly. 2. No leverage, ever. The exchanges and protocols want you to use leverage because it generates fees for them and liquidations they can capture. Leverage is how you donate your stack to the market. Don't do it. 3. The minimum regret portfolio. This is designed so that when you look back, you won't think you were an idiot. The framework. Focus on layer 1 blockchains with real adoption. They're big enough, adopted enough, that they won't go to zero in one cycle. They might bleed slowly, but they won't collapse instantly. 4. Don't rent conviction. Don't just follow what someone else says because they're prominent. Check the data yourself. ChatGapt is free. You can verify on-chain metrics, user growth, stablecoin flows, developer activity, transaction volume. If you can't verify the thesis yourself, you don't have conviction. You're renting it, and you'll sell at the worst possible time. 5. Time horizon. The 5-year cycle. I've extended my crypto cycle thesis from 4 years to 5 years. The liquidity that was supposed to arrive in year 4 has been pushed to year 5, 2026. The $10 trillion refinancing wave creates the setup. If you're trying to trade this on a 3-month time frame, you'll get chopped up. The short term is noise. The long term is signal. Position for 2026 to 2027. That's where maximum money printing comes. Part 8. The exponential age opportunity. Let me put this in broader context. The crypto market today is approximately $3.5 trillion. My thesis is that within 10 years we could reach $100 trillion. That means we're only 3.5% of the way there. Think about what that implies. If you're positioned correctly today, you're not catching the end of a cycle, you're catching the beginning of a secular transformation. This is the exponential age thesis. Network effects compound exponentially. Each new user adds value to the entire network. Traditional valuation models, DCFP or E, don't apply. The only framework that works is Metcalfe's law. Crypto allows you to own the infrastructure layer of the next internet. You can't buy equity in TCP or IP, but you can buy equity in Ethereum, Solana, Sui. This is unprecedented. The debasement trade will continue until approximately 2032, when the debt dynamics force a restructuring that gives you another 6 to 7 years of tailwind. AI and robotics will eventually rewrite the rules of GDP growth, but before that happens, the current financial system must navigate the refinancing wall. The only way through is liquidity, and liquidity flows to scarce, exponential assets. Part 9. WHAT you should sell. So what should you sell? 1. Cash and cash equivalents. Cash paying for -5 when your hurdle rate is 11% is a guaranteed losing position. You're losing 6-7 per year in real terms. Cash is not safety. Cash is slow-motion wealth destruction. 2. Long-duration bonds. Bonds were the hedge for a deflationary world. We're in a debasement world now. The correlation with stocks has broken down. They no longer provide the diversification they once did. 3. Real estate with caveats. Real estate faces a $1.8 trillion refinancing wall. Properties bought with 3- for financing now face refinance rates nearly double that. Values have softened. Distress is rising. If you own real estate with locked-in low rates, hold it. If you're considering new purchases, be very selective. 4. Diversified portfolios. The 60/40th portfolio, target date funds, diversified ETF portfolios. These are designed for a world that no longer exists. Diversification across assets that all lose to the hurdle rate is just diversified losing. 5. Most altcoins. This is crucial. There are now tens of thousands of tokens. Most of them are worthless. Most will go to zero. Liquidity can't save every project. In the past, everything went up, not anymore. The returns come from concentration in quality, not spray and pray diversification. Part 10. The last chance window. Here's why I say last chance before 2027. The debt refinancing wall hits hardest in 2026 to 2027. This is when maximum money printing comes, but the crypto market cycles with a lag. 2. Liquidity. When liquidity increases, it takes time for that money to flow through the system and into risk assets. If you wait until liquidity is obviously abundant until it's on CNBC every day, you'll be buying much higher prices. The time to position is before the liquidity wave arrives. That's now, February 2026. Bitcoin at $67,000, Solana at $82, SUI at $0.94. These are prices that reflect fear, not fundamentals. The October 2025 liquidation crashed the market. The US government withdrew liquidity via the Treasury general account. The government shutdown disrupted funding flows that created the setup, the bottom fishing zone. I think the market has bottomed. The fear is still here. The prices still reflect uncertainty, but the liquidity is coming. The $10 trillion must be refinanced. The math demands it. And when it comes, the assets positioned to capture it will move. This is the last chance to position before the wave.